Elon Musk just put around 300 million Tesla shares into his own name at $23 a share. He did that in the same month the market called him a distracted fraud who misses every deadline. One of those two groups is about to be very wrong, and the gap between them is the whole bet. Here is why that gap is open. There is a real chance Musk merges Tesla and SpaceX inside 2 years, and the market cannot price it because it cannot decide whether he is a generational builder or a distracted promoter. On the betting markets, Polymarket puts the odds near 38% and Kalshi near 24%. The president of SpaceX has already gone on CNBC and said a combination would make Musk's life easier. The second that deal turns real, the entire case against Tesla gets retested. So one question, answered with a verdict and not a hedge. Is Musk the rare owner who turns a good company into a stock that returns 100 to 1? And does this merger make Tesla a better bet or a worse one? We grade him on one thing. Plenty of forces drive a stock that compounds for decades: the product, the market, the margins. But the one most investors underrate, and the one we put under the microscope, is the person at the top. An owner-operator is the founder who runs the company and owns a huge slice of it, so his money and yours move on the same days. You do not strictly need one to compound a stock, but a great one tilts the odds hard in your favor because the product and the edge over rivals still have to be steered, and that steering is one person's decisions about where the company's money goes over a decade. So the question is whether Musk is the rare owner-operator a generational stock requires, and it comes down to 4 things. Is he aligned? Does he think in decades? Does he spend the company's money well? And can you trust where he says he is going, even when you cannot trust when? Here's the lazy version of the case against him, repeated everywhere because it's easy and it makes the speaker feel smart. He runs 5 companies. When one is on fire, he's online picking fights. He has missed his own self-driving deadline in roughly each of the last 8 years. Robotaxi was promised at scale by 2020 and is not there. Cybercab was promised by now and is not in production. Tesla's Texas robotaxi fleet has 69 vehicles. The supposedly slow Waymo has 620 in the same state. So the conclusion writes itself. A promoter cannot also be a compounder, and the merger is just the next magic trick. That take takes 10 seconds to say. It has also been wrong for 20 years. Because late is not the same as wrong, and a late builder who ships is rarer than a punctual one who never delivers. Reusable rockets were called impossible for 2 decades. SpaceX now flies them most weeks. Mass-market electric cars were called a money pit. Tesla now ships north of 1.5 million a year. Both were years behind his own timeline. Both happened. The timing was optimistic, the direction was real, and most of the market still cannot tell those two apart. That confusion is where the market gets the price wrong. And Musk is not the first great builder the market has misread this way. The framework we run every company through was built by studying the rare stocks that returned 100 to 1, and the same profile keeps showing up. Jeff Bezos ran Amazon at a deliberate loss for almost 2 decades, plowing every dollar back in while Wall Street called it a fantasy with no earnings, and it became one of the great compounders ever made. Jensen Huang spent 10 years building NVIDIA's software for an artificial intelligence market that did not exist yet and was treated as a fool right up until he was crowned a visionary. The best owner-operators almost always look reckless before they look inevitable. So why does the market fall for that case every single time? Because it is built to. It runs on quarters, not decades, and the people who price it are paid to be right this year, not in 10. Standing up and saying, trust the destination, ignore the date, is career suicide on Wall Street, so almost nobody says it. The edge here is not secret information. It is simply being willing to hold what almost everyone else is structurally unable to. So is he a liar? No, and that distinction matters more than anything else here. A liar sells you a destination he knows is fake, and that destroys your capital. An over-optimist sells you a real destination on a date he cannot hit, and that only costs you patience. Musk has always been the second kind. The deadline slips, the thing itself arrives. For anyone holding a true compounder for around 16 years, that is the entire game. You can survive late, you cannot survive fake.
Run the 4. 1. Skin in the game. This month, Musk claimed his entire 2018 Tesla pay package, buying around 300 million shares at $23.34 and pushing his voting power near 20%. Those shares are locked up until early 2028, so there is no big block of stock about to hit the market and sink the price. Largest individual owner of Tesla, controlling owner of SpaceX and xAI. Nobody at this scale is more aligned. 2. Time horizon. Tesla is a 20-year project, SpaceX a 23-year one, Neuralink and xAI multi-decade bets. And he has bet the whole company more than once rather than cash out, pushing Tesla to the edge of bankruptcy to get its first mass-market car built, and pouring his own fortune into SpaceX while its first 3 rockets failed to reach orbit. A quarterly mind takes the safe exit every time. He never has. 3. Capital allocation. This is the heart of it. Does he take the company's money and turn it into something that pays off? He does it better than almost anyone at his scale, and the pattern never changes. He bets on something the experts swear is impossible, builds it anyway, and it ends up printing cash. A rocket that lands itself and flies again. An electric car normal people would actually buy. A fleet of satellites beaming internet to the whole planet. Every one was written off as a fantasy. Every one became one of the highest return bets of the past generation. And this is not just old history. Right now, his energy business is signing record battery storage deals, including one of the biggest ever in Europe, all very profitable, money the market barely notices because it is fixated on self-driving. On the company's capital, his record is the best one in 10. 4. Integrity. Pass with the caveat already made. Late, not fake.
So add it up. He passes all 4, and more cleanly than any operator at his scale. He has one real flaw, the one everyone fixates on. He misses his deadlines. It is true, and it does not sink the case, because the one thing that would sink it, a destination that turns out to be fake, is exactly what he does not have. And for an owner-operator, that is everything. A combination does 3 things to that case at once. It concentrates his stake further so the alignment gets stronger, not weaker. It formalizes a tie that already exists. The two share a chip venture called Terafab with xAI, roughly $20 to $25 billion, plus AI infrastructure, and Tesla already owns a slice of SpaceX. And there's a quieter third effect that matters most for our test. A company built around his control of SpaceX is one no board, no rival investor, and no shareholder revolt can ever wrestle away from him. The biggest risk to any owner-operator stock is that the owner gets pushed out at the wrong moment. This deal makes that close to impossible, and it locks the alignment in for the multi-decade horizon the thesis actually needs. So when does this happen? The tell is in SpaceX's own stock. It is trading high right now because barely any of its shares are free to buy yet. The day its lockup ends and the early investors can finally sell, that scarcity breaks and the price usually slips. So Musk's window is before that unlock, while SpaceX is still scarce and richly priced. And that high price works in his favor twice. It is strong currency for buying Tesla, which protects his own side, since his bigger stake is in SpaceX, not Tesla. And it is what gets Tesla shareholders to vote yes, because they're being paid in SpaceX stock. And a pile of SpaceX shares only looks generous while that stock is flying. Let the lockup cool SpaceX off, and the very same offer looks cheap, and the vote gets shaky. So expect this sooner rather than later. For once, the incentive is to beat a deadline, not blow through it. Now the honest part, because a verdict with no way out is just cheerleading. What would actually prove this wrong? Two things, and only two. The first is if late ever turns into fake, if one of these core promises is exposed as something he always knew he could not deliver and sold anyway, rather than a real goal he simply missed the date on.
That would not dent the thesis, it would end it. The second is if the alignment breaks, if he starts dumping his core stake, checks out, or runs Tesla as a piggy bank to prop up his other companies. So here is the watch list, and notice what is not on it. Not the next blown deadline, the market already expects those. Watch instead for a promise quietly buried instead of shipped late, or him quietly selling his way out of the company. Until one of those happens, late is still just late. So the call? No hedge. On the man, Musk passes the owner-operator test, and not by a hair. On the merger, it strengthens the one thing we just graded him on. It deepens his alignment and tightens his control, so the owner-operator layer that makes this stock work gets harder to water down and harder to remove. Right now, the price is handing you a window. Tesla is down this year, with all the bad news already weighing on the price. A fatal crash lawsuit, the federal safety probe behind it, and Europe moving to block its self-driving. None of it breaks the thesis, it only tests it. The market is pricing this merger as a distraction. It is the opposite, the next step in locking in the rarest profile a generational stock can have. The merger is the thesis, not the threat. That is the whole game, late versus fake, and which one a long-term holder survives. Get that right, and Musk stops being a controversy and looks like exactly the owner-operator a stock like this needs. Most of the market never makes that distinction because it takes more than 10 seconds. That is the edge, and it is the lens we put on every company we cover. If that is useful, subscribe, and we will run the next one together. This video is for informational purposes only and is not financial advice. All investments carry risk. Make your own decisions based on your own circumstances.